If you were born before 1962, stop scrolling for 1 second because this one is about you specifically, not seniors in general. There is a government-backed program that has existed for decades, insured by the federal government, that lets homeowners exactly your age turn part of the value of their home into cash, without selling, without moving, and without a single monthly mortgage payment. And here's the part that should genuinely bother you. 3 out of 4 people who actually qualify for it never apply, and almost every single one of them stays away for a reason that isn't even true. Stay with me to the end of this one because I'm going to walk through the 3 specific myths that talk qualified people out of a program that was built for them. And after that, I'm going to give you the exact 3 questions to ask a counselor that separate a real approval from a wasted afternoon. That last part is the part people usually message me about afterward, so don't leave early. Let's start with the math, because born before 1962 isn't a random cutoff, it's the actual eligibility line. The federal program we're talking about requires every borrower on the loan to be at least 62 years old. If you were born in 1962 or earlier, that box is already checked for you. That's it. No test, no application to prove your age qualifies. It either does or it doesn't. And if you're watching this, there's a real chance yours already does. Before I go further, let me tell you who I am. My name is Gerald Whitfield, and I've spent years sitting across kitchen tables from homeowners exactly your age, walking through this exact paperwork, this exact program, and this exact list of myths that keep good candidates from ever picking up the phone. I'm not a loan officer, and I'm not here to sell you anything today. I'm here to walk through what's actually true, because the gap between what people believe about this program and what the program actually does is enormous. Myth number 1. I have to own my home completely, with nothing owed. This is the myth that stops more people than any other, and it is simply not accurate. Here's what the program actually requires: substantial equity in the home, not zero mortgage balance. In fact, one of the most common uses of this program is paying off an existing mortgage entirely as part of the transaction, using the new loan to eliminate the old one, which means a homeowner can go from having a monthly mortgage payment to having no monthly mortgage payment at all on the same day, using equity they already had. Let me translate why that detail matters so much. A lot of people over 62 are still carrying a mortgage payment every single month, sometimes a large one, and they assume that payment disqualifies them from any program that involves their home's equity. It's the opposite. This program is often specifically useful because of that remaining balance, not despite it. Here's the part that matters most. The actual threshold isn't zero balance. It's enough equity relative to the home's value, and that number is calculated during the process, not guessed at beforehand. Which means the only way to actually know where you stand is to go through a free eligibility conversation, not assume you're disqualified based on a number you never checked. Let me tell you about Arthur. Arthur was 66, still had about $60,000 left on his original mortgage, and had convinced himself for 3 years that a reverse mortgage wasn't for people who still owed money. When his daughter finally pushed him to just make one call, Arthur found out his home's equity was more than enough to pay off that remaining $60,000 balance entirely through the new loan, and still leave him with a line of credit besides. Same house, no more monthly mortgage payment, money left over. The only thing that changed was that Arthur finally asked instead of assuming. Myth number 2. My credit isn't good enough, so I'll get denied. This is the second myth, and it comes from people applying regular mortgage logic to a program that doesn't work that way. With a standard mortgage, the lender is entirely focused on one question: can you make this monthly payment reliably for the next 30 years? Your credit score is the shorthand answer to that question. But this program doesn't have a required monthly mortgage payment for you to make, which means the entire logic of credit score decides approval doesn't transfer the same way. Let me translate what lenders actually check instead. There is a financial assessment, and it does look at your overall picture, but it's evaluating whether you can keep up with property taxes, homeowners insurance, and basic home upkeep going forward, not whether you've ever missed a credit card payment. Some past credit issues can even be addressed directly through what's called a set-aside, where a portion of the loan proceeds is reserved specifically to make sure those ongoing costs get covered automatically. Here's the truth underneath this myth. This program was designed with the understanding that people over 62 often have complicated financial histories, a medical bill that hurt their credit 5 years ago, a period of reduced income after retirement. It was not built to punish that history. It was built to evaluate your situation going forward. I think about Lorraine, who was 71 and had a low credit score from medical debt after a hip surgery years earlier. She assumed that score alone would end the conversation before it started. It didn't. Her overall financial picture, steady Social Security income, a paid-off car, no other major debt, was more than enough, and the set-aside option covered her ongoing tax and insurance obligations automatically, addressing the one area where her income had been tightest. Lorraine's credit score, the exact thing she thought would disqualify her, never even came up as a problem once she actually went through the process. Myth number 3. My kids will be stuck paying off my loan or lose the house. This is the myth I hear the most, and it's the one that carries the heaviest emotional weight, because it isn't really about money, it's about not wanting to burden the people you love. Here's the actual structure of this program, and I want you to really hear this part. It is what's called a non-recourse loan. That means the amount owed can never exceed the value of the home when it's sold, no matter how long you've lived there or how much the loan balance has grown. If the loan balance somehow ends up higher than the home's value, your heirs are never personally responsible for that difference. The federal insurance behind this program exists specifically to cover that gap, not your family. Let me translate what that actually means for your kids. When the home is eventually sold, whether that's after you pass away or after you move out permanently, your heirs have real options. They can sell the home, pay off the loan balance, and keep any remaining equity for themselves. They can choose to pay off the loan directly if they want to keep the home in the family. Or, if for some reason the home is worth less than the loan balance, they can simply let the home satisfy the debt and walk away owing nothing further personally, ever. Here's the part people never expect. Far more often than not, there is equity left over for the family after the loan is settled, not a debt handed down. This program isn't designed to strip an inheritance away. It's designed to let you access money you already own while you're alive to actually use it, with federal insurance covering the risk so that risk never lands on your children. Sam and his sister went through exactly this after their mother passed. Their mother had used a portion of her home's equity through this program for nearly a decade. Home repairs, a health scare, a bit of breathing room every month. When she passed, the loan balance was less than the home's value. Sam and his sister sold the home, paid off the loan, and split what was left, which was still a meaningful inheritance. The myth they'd both believed for years, that this program would leave them with nothing, or worse, a bill, turned out to be exactly backward. Here's what ties all three of these together, and it's worth saying plainly. Every one of these myths comes from the same place. This program gets compared to a regular mortgage using regular mortgage rules when it was built with an entirely different structure from the ground up. Once you separate the two in your head, most of the fear disappears, because the fear was never really about this program, it was about a different product entirely that shares a surface-level resemblance. Now, here's what I promised you at the beginning. The 3 questions that separate a real approval conversation from a wasted afternoon. Ask any counselor or lender you speak with these exact 3 things. First, based on my home's estimated value and what I currently owe, what is my rough eligible amount? Second, what are my 3 payout options and can I combine them? Third, what ongoing costs will I be responsible for and is a set-aside available to cover them automatically? Any legitimate conversation about this program should answer all 3 clearly and specifically, with real numbers tied to your actual home, not vague reassurances. If you ever get vague answers to those 3 questions, that's your signal to call a different HUD-approved counselor instead. This is general education, not financial or legal advice for your specific situation. This program has real costs, real ongoing responsibilities, and real details that depend on your specific home, your specific loan balance, and your specific state. So before making any decision, sit down with a HUD-approved reverse mortgage counselor, which is actually a required step before you can move forward with this program, not an optional one. which means the very first phone call is protected, unbiased, and typically low or no cost to you. So here is exactly what to do this week, born before 1962 and watching this right now. Call a HUD-approved reverse mortgage counselor. A quick search for HUD-approved reverse mortgage counseling will get you there. And ask the 3 questions I just gave you. Write them down if you need to. Bring them to that call word for word. You are not committing to anything by making that call. You're simply finally getting real numbers in place of the myths that kept you from ever asking. If this changed how you see this program, do one thing for me. Share it with someone you love who was born before 1962, especially anyone you've heard say, "That's not for people like me," about a reverse mortgage. That sentence is almost always built on one of the 3 myths we just took apart, and you might be the reason they finally make the call instead of assuming the answer. Subscribe, turn on the bell so the next one finds you, and I will see you in the next video.